All right, so we are live. I hope this headset's working. I just got it at the office here, so hopefully I'm live. Hopefully you can hear me. And the chat is open, so if you have any questions for me, I am a mortgage nerd. I've been doing home loan lending since 1999, mostly here in the state of Utah. And I've got this new shirt, and I got a hat too. Where'd my hat go? Oh, check this out. It's got a little nerd upside down. So normally I put the nerd kind of the 3 kind of backwards, and I thought, oh, this is kind of fun. Have everything else upside down except for the 3. So that's a fun one. If you go to nerd merch, and nerd is with the 3, you'll see all this nerd stuff that I've been creating and having a lot of fun with. And today was a little chillier in southern Utah. We actually had a frost warning, I think, that popped up from like 3 a.m. to like 9, and pretty early and really rare. I mean, we haven't been that cold yet. And so I got my little hoodie on, kind of representing nerd. So I'm here to answer any questions you have about real estate financing, mortgage loans, credit, anything of that nature. So now let's find some questions here real quick while we're live. Oop, wrong one. But if you have any questions, jump in the chat. Love to answer any questions about credit, real estate, mortgage, financing, investments, anything. And if I don't know, I can point you in the right direction or find out later. But yeah, let's see if we can have a fun little conversation tonight about real estate financing. So let me go to Cora's always got some cool question and answers. So let's see what this looks like today. Okay, the question reads this. Is it possible to be denied for an FHA loan after receiving conditional approval? Absolutely. That's why it's a conditional approval. We may not have all the paperwork just yet. Maybe we need updated pay stubs. Maybe we need something with title report, appraisal, income, asset verification, down payment verification. There's still a lot of things that are happening. And if something comes back that doesn't match, then we have to rerun it through the system or have the underwriter review it, and it may end up turning into a loan denial. So hopefully you have enough of the file together before it gets to that stage where you don't have anything that just comes out of nowhere. But the short answer is yes, it can be denied in a lot of different stages as new information comes in. So let's say, for instance, somebody says they make X amount of money, we get their pay stubs and W-2s, and it doesn't add up to that number. Maybe they've taken time off this work or had an injury or something where their year to date is less than what it was as a 40-hour work week or something like that. Or maybe they say they have the down payment, we verify the bank statement, and it was a gift fund or a loan, or they don't have their down payment, or they're going to get it in the future, they're selling a vehicle. There's all kinds of stuff that happens with these mortgage loans. So the answer to this question is yes, it can be denied. I've even seen at closing, where you're at closing and all of a sudden the person loses their job, or they don't have the money in their account anymore, so something happens between signing the loan and actually getting the keys, can still have things that can pop up. So the loan's not done, the home's not yours. I've been in this business long enough to see the craziest things happen during the process, after the process, at closing. So part of our job is to hopefully head those off at the pass, make sure we're ready for those. But the short answer is yes, you can be denied throughout the process, even if you've gotten some sort of stage of approval, which most commonly is called a conditional approval. Let's see what else we got here. Can you have an FHA loan and co-sign on another FHA loan? Yes, as long as the other person is buying it as a primary residence. So you can't use FHA loans for investment properties, but you can have an FHA loan on your current. Your kids are getting a home and you're co-signing or helping them with that, as long as debt ratios and everything else qualifies. The answer is yes, you can, as long as the other home is also a primary residence for whoever you're co-signing for. A quick tip on co-signing. You are equally responsible for that loan. So if you sign a loan for a kid or family member, brother, sister, whoever is on that loan is equally responsible for that loan, and it will show up on both credit reports. So if they miss a payment, you miss a payment, whatever happens will affect everybody that is on that loan. And the only way you can remove a co-signer is either selling the property, or the original borrower or whoever you're doing the loan for can then qualify on their own to remove you. So it can affect your debt ratio, your credit. You just want to make sure your eyes are wide open going into cosigns. Starting to see this a lot more common, especially with my brothers and sisters, or maybe roommates in college, or more of these people kind of having to team up for this first home to make it more affordable and to be able to build equity credit. It's better than renting. So I'm starting to see a lot more kind of team ups, more co-signing on the initial first home. And I think it can be a really good opportunity to help everybody get into their first home, build up some of that equity, and then split it, then move on to the next house down the road. What other questions? Do we have any questions in the chat? So if you have any questions, go ahead and jump on. I wonder if there's a way to announce this somehow. I wonder. Oh, it looks like I can. Okay. Let me do that real quick. I'm going to share it on Facebook. And let's see if anybody jumps on there. Oh, what a stupid image. What a fun little thumbnail. Anyway, Mortgage Nerd. All right. And I've got my headsets kind of making my hair look all weird. Oh, no. All right. We're live. Oh, I still have my earbud in. I still have my earbud in for my normal phone. How funny is that? All right. All right. Let's see what else we got. I love answering questions. I love having fun with this. So if you have any questions, please pop in on the chat. We'll jump onto that question. Let's see what else we got on the real estate side. Let's see. Have you ever applied for an FHA loan with a credit score below 580? What was your experience like? A very common question I see on Quora or I see posted is, can I get a home loan with bad credit? And the answer is yes. It just usually requires more money down. So when you're 580, 500 credit score, it will come down to why it's that score. There may be things you have to pay off or settle on or restructure, that you have to kind of get rid of some of that debt, or at least get it back to current, or at least make payments. Or prove that it's paid off and just hasn't updated on the credit file yet. But almost everybody's going to require more money down. Where if you can get to a 620 credit score, you'll see a lot more 100% financing options open up. If you can get to 660, the rates and terms start kind of kicking in on some of these programs and make it a lot cheaper. So I would say it's worth working on the credit for a little bit while you're trying to get your other finances put together. And that's where I can do a free review for you that's kind of gives you an idea where you're at. Then you can take the next 90 days, 6 months, 1 year, whatever it is, to get the score where you will get a better loan. Because there is somebody that'll lend to anybody, but it usually will require more money down. The terms aren't going to be as good. And it's not crazy hard to get you back into that kind of 620-ish range. So I think the effort should be into that than just trying to find any loan that will loan to you, and just kind of learning how credit works. And so many people, they don't know how credit works when they're young. They just kind of bury their head in the sand. They'll have a charge off, a collection account, medical, whatever it is. And knowing how your score, why it is what it is, can make a big difference going forward. So let's start with a free review. We can do a soft credit check. We can do a hard check, whatever you want to do. And I'm willing to work with you on it. It's not something where you have to be able to buy a home today to work with me. I've worked with clients for 6 months. I've worked with them for a year to kind of get them ready into home ownership. And honestly, it's really rewarding to be able to problem solve, help people get there, and just the excitement they get when they get their credit scores up. It's just such a wonderful feeling to get them kind of back onto a better track. And sometimes there's setbacks. We get into it 3 months, something else pops up, and you kind of step backwards again and forwards and backwards and forwards. But if you don't start the process now, what's going to happen a year from now that'll be any different? Maybe rates will be better a year from now, but home prices will be higher and you missed another opportunity. And credit ties to everything, not just home loans, employment, car loans, insurance, so many things tie to credit, that if you can get better at managing it, kind of figuring out ways to know why it works the way it is, work on some positive, get rid of some negative, you'll be in a far better situation going forward on anything involving credit. But if you don't start today, where are you going to be in 6 months? So many people I talk to, they give them the tips, we try to work when they just disappear. And then 6 months later, like, oh, I really wanted to get back on buying a house. It's like, you just wasted 6 months where we could have been doing something. And I go, did you do anything I told you? Did you work on anything? You make some calls, settle on the accounts. Oh, no, I haven't done anything. It's like, don't do that. Regardless if we can't get you into a home loan, working on credit only helps you on so many other ways, so many other finances, insurances, getting a rental property, getting anything. A lot of stuff ties to credit, and getting your score up. Not only is there a sense of pride with it, but just so many things open up with home loans, car loans, all of it's tied to credit. So work on your credit. If you don't know how, talk to me, call me, check out my website, ryanbolton.com. I can walk you through why your credit is the way it is and what you can do to get it up. All right, little soapbox there, but credit's a big part of what I do. Let's see, can I take out a mortgage and not live there? Yes. The issue is at the time of the loan, if it's not going to be a primary residence where you're going to live and return and just be your primary residence, then you have to do a different type of loan. So there's loans for second homes that are more vacation type things where you maybe use it for the summer or the winter or vice versa, that you typically don't rent out in between. So it is something where the occupancy is a big part of what type of loans you're going to get. And a lot of it has to do with risk. If you have a primary residence and then a rental property, foreclosures are higher on rental properties because maybe the person can't afford both, or maybe the home gets trashed by a renter or a squatter, or all the things that happen with real estate investing, and more people walk away or just can't handle investment properties. So it just requires different rates and terms, different guidelines. And so the question is, can I take out a mortgage and not live there? Yes, it just will be different terms, different interest rates, different down payment requirements. There's all kinds of loans to help people into investment properties. And it also depends on what you mean by live there. It means that some part of the year, I mean, there is a little nuance with that, but generally, yes, there will be a loan that will fit that type of need. Is it possible to sell a house before fully paying off loans and mortgages? No. So when you sell the home, you're handing over the ownership of that home to somebody else. There's always a due on sale clause with your existing mortgage loans that say, okay, if you transfer ownership other than moving into like a trust or an LLC, when you're no longer the owner and you are selling that property, those liens need to be paid off to give that other person free and clear title. And then if they're getting a loan, then a new loan kind of replaces the loan that you have. But you can't sell the property without paying off the debts that are tied to that property. So the very short answer is no, you've got to pay off those loans. Now, you may be able to work with that lender and have the loan move to another property or a judgment or something like that, but no, any taxes, anything owed. And if you think of it this way, if you're the buyer of that home, would you want somebody else's mortgage still on the property? No, because that's the collateral for the loan. So if all of a sudden they start missing payments and you've left that loan there, then all of a sudden they can come after and take your house. So, and if there's another loan involved, there's lender's insurances, there's owner policy insurances to make sure ownership is properly changing and all liens are released and all the new liens are put in its place. Because a lot of times you'll have a seller that has a mortgage and a new mortgage to buy the house. They get paid off with that loan and the net proceeds go where it needs to go and commissions and all that type of stuff. But I see this question often, even with divorce situations and things like that, where they're trying to figure out what they do with the property. But very short answer to that question is no. You have to pay off any liens, any loans against the property before you can sell as part of selling the property. So you can't sell the property without getting those liens covered. Here we go. This one came in just a little while ago, it looks like. FHA cash out refinance question. I received a clear to close 7 days ago, and I'll be signing documents in 3 days. Will they do a soft pull on the day of signing or the day of funding 4 days later? Very interesting. So a lot of times they will do a pre-funding checklist, and that's where they can do a soft pull. They can check your employment. Employment, they actually have a time frame they can do it at signing. They have a little bit of a window to check the employment, but a lot of times they are trying to do it kind of as close to funding as possible as kind of part of the funding checklist to make sure something hasn't changed. And the main reason we do a soft credit pull is to make sure you didn't go out and get a new car loan, or what you'll see is people will get like a RC Willey or a Boulevard Home Furnishing or some sort of Furniture Row credit card to get new furniture or appliances or washer and dryer or stuff like that. And they get it 90 days, same as cash, 6 months, same as cash, or some sort of free credit card. And that inquiry now shows up when we do a soft check. And now we have to make sure it doesn't mess up the debt ratios. We have to make sure that expense is actually added. So just wait to pull new credit, or at least let your loan officer know, especially if you're getting close to signing the paperwork. Don't pull credit without talking with your lender. Now, you do see times where utilities will pull credit, but that'll show up as a different type of inquiry. So we'll know that, okay, that's a utility company. That's a little bit different than, say, a new credit card, a Visa, a car loan, some other type of inquiry. When that pops up, that could delay your funding. That could delay recording the loan. They can say, oh, hey, we have this new inquiry with Chase or with a credit union or with a furniture store or something like that. Now we need to investigate if a new loan was taken out. And now all of a sudden, if you have some sort of $300 payment or more and your debt ratios are tight, you could actually lose your funding. You could lose out on your home. And it's really sad when that happens, because earnest money is at risk. Now you're trying to move in, you got movers, maybe you've moved out of a rental. It's one of the worst situations we can see as a mortgage company. And a lot of times we're trying to educate clients as we go through it. Just don't pull credit unless you let us know why or what's going on. Now, I've seen times where they need to get a new car loan. They're going to trade in a more expensive one, get a cheaper one. At least we're involved in that change, so then we can head it off before you get to funding. But this question is interesting. So I don't know why they're trying to pull us off credit, or why they're trying to pull credit, but it may be something like that. New auto loan, furniture store, appliances, washer and dryers, that type of stuff. Just wait. Very much communicate with your loan officer if there is a need for some sort of credit inquiry. See if we have any questions yet. All right, let's see what else we got. We're going through the questions tab here, see if there's anything fun we can do. Any question? Let's see. Will mortgage rates in the US be around 6% well into 2025? A lot of that's crystal ball. I think a lot of the metrics, a lot of the things that are happening with inflation numbers are pointing towards interest rates getting better. Now, when and how and if, and elections now are over, that may change some projections and things like that. But a lot of it is just educated guesses on just what's happened in the past, what we see, where the margins are at, the yield curves. There's so many things that determine interest rates. But there seems to be a little bit more pressure to move interest rates down going into 2025. And I see a lot of people waiting until a magic number of 6 or 5 in front of the number pops up. And I think that yes, it makes sense to try to wait and try to time it, but it's so hard to time interest rates, just like it's so hard to time buying stocks. If you're in it every single day, it may be a little bit different, but I'm in this every single day and I can't tell you exactly when interest rates are what they're going to do, but I can tell you what you qualify for today. And if a home fits the budget today, you can always refinance if rates get better. But if we see a bunch of people waiting for a certain interest rate, the competition goes up. We already have a limited supply, and the limited supply is in the lower price range, is that most of the people are waiting for lower interest rates. So if all of a sudden you have 2 people that can qualify for the house and all of a sudden it goes up to 10, who's going to get the house? The one that can offer more, that can finance more, put more money down, can close quicker. So that's where you see a lot of pressure on prices going up if interest rates actually go down. So it's important to wait, make sure the timing is right just for your budget, make sure you can do it. But I see a lot of people that are going to wait themselves right out of this market, or they're going to end up paying a lower rate, but 50 grand more for the house. Where if they would have got the higher rate at the lower price, they can still get the lower rate in the future if rates go down, but they can't get the lower price. The price is going to be much more market driven, where the interest rates are going to kind of ebb and flow also off the market. But I see that's going to be a huge potential because we're not seeing a lot of existing homes hitting the market. So we're missing out on a big section of our inventory because so many people have such a low rate on their home, they can't replace it. So they're staying in their homes longer. So there's less inventory on the existing side. There's less foreclosures and defaults. So we're not adding inventory that way. The only way inventory is getting added is through new builds in many cases. So it's one of those things where it's kind of a catch-22 of wait for the better rate, but then pay more for the house, or find a house that works, find a house that fits. I mean, that's the other thing. If you wait, this home that you like that fits, that's close to your school or work or whatever it might be, will probably be gone if you wait for the interest rate. So not only is that house going to be gone, but it's probably going to be more expensive, and your rate may or may not go down enough to really offset that increase. So I think it's just better to get pre-approved, find out where you're at, be ready to make the strongest offer you can. And when the market hits, or when the rate hits, or when the home that fits your needs hits the market, bam, you can jump on it and be ahead of this curve or rush that we're going to see, I think, in 2025. Let's see. How much will I save on interest if I get a 15-year mortgage instead of a 30-year mortgage? It's a huge difference. The first 5 years on a mortgage is almost all interest. But when you lock in a 15-year payment, you have to make that much larger payment as well. So there's a balance between kind of locking in the low payment versus having the minimum payment be a little bit lower and paying the extra. It's amazing what an extra $100 or rounding up your payment can do, especially over the first 5 years. But I would also say, how long are you planning on keeping the home? If you're not going to keep it 15 years, paying that extra payment is kind of a lot going into that one bucket, where I always look at with clients and say, okay, what else can we pay off that frees up more money than putting everything towards a mortgage? Maybe we accelerate the car payments, accelerate other debts, or increase savings. So you have your savings, retirement, that's going up while the mortgage is going down. So I don't think it's cut and dry, 15-year term, 30-year term. It is something where it's important to sit down and say, okay, what's an overall budget strategy, and figure out where is the best use of that money. And I'll tell you, a lot of times putting extra money to the other debts, getting rid of those, then take that debt and put it towards the mortgage will actually save you more interest than just locking in the 15-year term on the first mortgage. But people don't have other debts. I mean, there's reasons why you do a 15 and a 30 year, but I think having that flexibility of the payment, diversifying it, will usually get you more ahead over the next 10 to 15 years than just doing a 15-year fixed mortgage. But the answer to the question, it's a big difference. There is a big difference in the interest that you'll save, but you're also paying a lot more per month to get it paid off that fast. So it's a matter of looking at where else can that money that may serve a better purpose long-term and short-term. All right, a few what else we got. Any questions? Pop on if you want. And I am a mortgage nerd. You see my shirt? Oh, check out this hat. How cool is the hat? It's not upside down. See? There you go. So it's at nerdmerch.com. I got all kinds of fun categories for car nerds and book nerds and science nerds, and I've just kind of been having fun creating this idea of just nerding out on a bunch of stuff. And I created another YouTube channel that I'm just kind of posting nerdy stuff. I just love studying stuff and reading stuff and nerding out on all kinds of different things. So hence the name. All right, what else we got here? Can I get a home loan if I have other loans? Nope. Yes. So if you have car loans, if you have either other mortgage loans, yes, you can qualify for more than one mortgage loan, more than one car loan, a couple car loans, a couple mortgage loans. So the answer is yes. That one reason won't hold you back. Now, if you have a lot of other debt, you may not be able to add a mortgage loan. You may not be able to add more debts. But the short answer is yes, you can get a home loan even if you have other home loans or other mortgage loans or other lines of credit or anything. So yes, you can get multiple home loans or a home loan if you have other loans. Is it possible to pay off a home early without incurring any penalties? It depends on the note. I would say 99% of the time, yes. Prepayment penalties have really gone by the wayside over the last 5-10 years, maybe. They were much more common on subprime loans back before 2008. But I think there are still probably some loans that have prepayment penalties of some kind. If you have some down payment assistance programs, sometimes there is a recapture of that assistance kind of built in during a certain time frame. That's not really a prepayment penalty necessarily, but yes, the short answer, you have to check your note. You have to see if there is that prepayment clause, but and I can help you with that. So if you have any questions, you can reach out to me. But generally speaking, prepayments have really been gone for a lot of years, and it's unlikely you'll have some sort of prepayment penalty. Now, you will have the interest that's accrued. So when you make your mortgage payment, say for the month of October, you're actually covering the interest of September. So if you pay off the loan, say October 15th or November 15th, you owe those 15 days of interest. So, and depending on if you made your payment yet for that month. So I see as much as, a month and a half of interest we have to add to your payoff depending on the timing of paying off that loan. But it's not really a prepayment penalty. It's just how interest works when you make your mortgage payment. And so, but it's not a payment penalty. It's not a penalty for paying it off early. But your note, the actual note will specifically say I may make partial or full payments on the loan without a penalty. That's very, very common, the verbiage you'll see on the note itself. All right, let's see. Can I rent out my primary residence while using an FHA mortgage? Depends on how long the FHA mortgage has been out. So it can't be something like right as you buy the house with an FHA loan, you turn it into a rental right away. So no, but if you've had the home for a while and you're turning it into an investment property, yes, you can keep that loan in place regardless of what type of loan it is. So if you're going to change the occupancy, you don't have to then refinance to a different type of loan. That loan stays with the property. It's based on the day you close the loan. You can also rent out maybe rooms. I see people, what if I rent out just a room or a basement or something like that? That's totally fine, especially if you're living in the property. That's a whole nother thing. But if let's say you've been living in the home for 1 or 2 years and you say, I want to keep the home and turn it into an investment property and start renting it out, do you have to refinance? The answer is no. You can keep that existing loan on the property. You can then go out and buy another home. Is there a backdoor way to get a cheaper mortgage rate? No. Money is at the cost of the time. It's based on the markets and all that kind of determine interest rates. The only other way to do it is buy down the interest rate. You can get your credit scores up, maybe get to the next tier that helps you with interest rates. You can work on any hits that you're receiving with the interest rate, but there's not some sort of backdoor way, as it says here, to get a cheaper mortgage rate. So there's a way to get the best rates available. Sure, there is ways to make sure you're getting the best rate with either down payment, with credit scores, debt ratio. There's ways to strengthen your file. But really, mortgage rates are a lot like insurance. They're risk. What is the risk of foreclosure? Well, more money down is less risky. Higher credit score, less risky. Lower debt ratio, more money in the bank. There's ways to strengthen your profile to get you a better interest rate, but there isn't like some backdoor way. Because really, when you think about it, it's just not how they work. It's a lot more like insurance is. So if there's some backdoor way for somebody with a lower credit score, less money down, less money in the bank, less time on the job, all the factors that go in, it kind of jumps in line of the other people that have those better criterias. So there is a way to get the best rates possible that day, but once you get the best rate that is possible for your scenario, there's not some backdoor way to get it any lower other than paying extra money with points or buy downs and things like that. But I think this is some sort of, hey, is there some sneaky wholesale way to get lower interest rates? And we all get the money from the same sources. We're all following the same guidelines. It's not like it's, especially when it comes to the lowest rates available, because they're the ones pooled together with the biggest amounts of security and securitization and that type of thing really sets the standard for those interest rates. So if you are finding some backdoor way to do it, it's a portfolio loan which won't have the lowest rates anyway. So the answer is no. How are we doing on time? How are we doing on questions? All right, let's keep going through the questions here. What would a 6% mortgage rate mean for you? Well, it makes your debt cheaper, possibly. If you have a 4% now, it doesn't make a difference. So it might get more buyers back to the table. We saw a pretty big boom right before the feds lowered the rate. It was like right after they lowered the rate, it went to poop. We lost like 200 basis points since that. I mean, it's just crazy how right up to the election. I mean, we started getting a little ground back today, but we lost. It was like unreal watching all the charts just rates get because it's like we started hitting that kind of six. We started seeing 5.875. We started kind of seeing that low sixes start to be more consistent. And now it's 7. It's it just was amazing how quick we lost it. But just during that window, application volume, refinance requests really started going up. That's what I'm trying to say to people. If we do get 5 back in front of that number, you know, there's going to be a lot more buyers, especially in the lower price range. All the people that want this big housing crash, they're the ones in the lower price range. Well, there's way more competition in that price range, which means prices are going to stay the same. Now, would there be some softening in higher levels, like higher loan amounts? Sure, but there's not as many buyers in that category anyway. But if you're in that 6 to 400,000 range, I know that's kind of a big range. Way more buyers can start affording that price range if the rates do drop. That means competition goes up. That means prices go up. So you can't adjust the price you're going to pay for the home. It's much more market driven, but you can find one now and kind of get ahead of that curve. And if rates do get better, you can always refi. But if rates get better and prices go up, you can't get the house at the cheaper price. Now, if the price of the house goes up 50 grand or isn't available anymore because somebody else was able to buy it, then it didn't matter that you waited for some magic lower interest rate. But I think there is pressure to move rates down. Don't get me wrong. All the metrics, all the forecasting does show rates are going to get better. Some are more optimistic, some are more pessimistic on what it's going to do. But almost everybody says rates should come down next year. But again, I think it can hurt home buyers, especially in that lower range. It's just going to kick up competition for the homes that are in that price range that people are waiting on. So I think it's not worth waiting. And again, if you wait 6 months, the house you're looking at today most likely will be gone to some other buyer. So it's a combination of, there's a saying in our industry that says, marry the house, date the rate. It's this idea if you find a house that works, that fits your budget today, your budget may only get better down the road, but the price may not, and the home just may be gone. So I think that we're, as an industry, trying to sell everybody, don't wait for some magic interest rate. Get your ducks in a row, get ready, find the house that works, and then we can always work on a refinance if it makes sense. How are we doing on time? Boy, I really hope this microphone's working. This whole time, I could just be talking and nobody can hear me. How funny would that be? Boy, should be working, right? Somebody get in the chat and let me know if it's working. All right, let's see. Should I pay extra towards principal if I'm just waiting to refinance my home? It always helps to have that extra money go into principal, but I always look in where else could that money go that could save you more money. Putting an extra 100 on the mortgage can make a big difference. But an extra $100 on a car loan, an extra $300 on other debts, especially installment debts, can go further than putting it on the mortgage. So I think it's a better use of that, or increase savings, make sure the 401s. There's other things you can do with that money. I think can be a little bit more strategic than just putting it towards the mortgage loan. But if you, regardless of what you're going to do with any kind of refinance, I think any extra money towards principal can help. But put it towards the other extra debts first. Put it to savings first. Make sure you have 6 months reserves. I mean, there's such peace of mind knowing you've got some money to fall back on instead of having to rely on debt all the time. So I think there's better places to put that money. And there's places to keep it more liquid. There's places that can make you feel a little more secure. There's places you can put it that will go further than on the mortgage. But if all that stuff's done, then yes, now start putting a little extra towards principal can only help you pay off interest. And if you go to refinance, the balance to pay off that old loan is that much less as well, which makes the refinance even more effective because you owe that much less on the house. So it always makes sense to do that once the other things are set up. A savings account, emergency fund, make sure 401 maybe contribute a little more there, see where your investments are going with that, and any other debts. Really, it will go further. $100 on the car loan, $200 on the car loan will go way further. And then all of a sudden you can take the entire car loan and put it towards the mortgage or savings or investments. So it's more of a holistic look at where the money's going than just doing a mortgage loan. How are we doing on time? Let's keep it rolling here. It's almost 6 Mountain Standard Time. How am I Mountain Standard Time people? MST. Oh, hey, I think I heard my voice in that for a second. Maybe it is working. Man, I hope it is. Let's see. Let's see. If you're approved for a mortgage, can you refuse to take it? Oh, yes. We can't force you. Even if you're approved, it doesn't mean you have to take that loan. If you don't like the terms or something changes or you don't want the house or yeah, just because you're approved doesn't mean now you have to sign that loan. And just because you're approved doesn't mean we absolutely have to fund that loan without having final approval, final funding, wires, all kinds of stuff during the process. So a very short answer is yes, you can refuse an approved loan. You don't have to on anything. You don't have to, if they are forcing you to take a loan, that's a whole nother story. So no, you should never feel forced to take a loan regardless if it's approved or not. What are some tips to plan? What are some tips to plan a home loan? What are some tips to plan a home loan? Okay. The best tips I can give people is try to get some savings built up. Almost every loan, regardless if it's 100% financing or you're putting 50% down, they like to see you have some reserve left over with your down payment. So it's very important to have some reserve, have some savings on top of any down payment requirements, even if it's 100% financing. Next is credit scores. You want to pay down revolving accounts under 30% of the limit, but not zero if you can. That'll help get you a little higher credit score, which may get you into a little higher tier. So I think that's another really big tip as you're starting to look at buying a home. You can always get your score up a little bit, and your revolving accounts are one of the best ways to do that. So reserves, credit score. Next, any kind of job, just make sure you're getting your full hours, your 40 hours. Make sure that you're making sure you're maximizing kind of your income on that stage. I see a lot of people say, well, I work 40 hours a week. We get their pay stub. We see their year to date, and they've been averaging 37 hours over the entire year. And maybe they took some time off or something like that we can explain. But a lot of times when we take the application at 40 hours a week, we get the pay stubs at 37 hours average. That 3 hours spread out over the whole month, can make a difference on what you're actually approved for. And that's where you see pre-approvals unstick, so to speak, where all of a sudden you were pre-approved because we went off the numbers on the application, but then when we get the pay stubs, it's off just enough that we now don't qualify, and that's awful. So that's why we try to get pay stubs, W-2s. We try to make sure we get that documentation first. But so many times clients are at a open house or something. They need a pre-approval letter right there, and we try to make sure, okay, we have everything based on what we have, but we really want to get more pieces of the ducks in a row. And I would say the biggest thing, get pre-approved. Before you start shopping for a house, go through this process first. get pre-approval, check the credit, see if there's anything you can work on, get bank statements together, where the down payment's coming from, get your hours at work, get your tax return done. That's where the pre-approval, I can say, okay, based on what we have today, here's what you qualify for. But if we go do X, Y, and Z, now you can approve for more. And we can work on that early. It's so much better having more time to work on a pre-approval than it is to say, well, I got to get out of my lease at the end of the month. I've got it under contract already. We only have 30 days to work on home inspections, appraisal, title, insurance. Wow, why put yourself in such a stressful situation where if you just start a little early, your ducks will be in a row, your offer will be smoother. There's so many things that will happen if you just take the time to start the pre-approval first before you go out, especially to put an offer on a home. And I'll tell you, a lot of sellers, especially with agents involved, they won't show the house until you're pre-approved. Like, why would we waste time on a contract and find out 30 days later, 15 days later, you can't get qualified for the house? This really is the first step, and it's free. There's no cost or obligation. I see people avoid this step when this is the best step to take. This is how you find out where you're really at. So check out my website at ryanbolton.com, BOLTON, ryanbolton.com. We can apply right there. You can schedule with me. We can make a phone call. We can get stuff started so that way you're in a better position when the house pops up or that you're ready to put an offer on a home. You got your ducks in a row. It's so much more smooth when you start this process early. All right, we've got plenty of time here. We're having fun. Is it possible? I think I may have read this. It's on a new screen. Okay, we'll skip that one. Let's see. How can I buy a foreclosed home with no money down? So it doesn't matter if it's a foreclosed home, who the seller is. In that case, it's a bank or a government entity or somebody that's foreclosed on the home. You can still get the normal loan. Now, with foreclosed homes, sometimes they're distressed. Maybe they need work and they don't qualify for traditional financing. So if they need rehab or they need work to get a traditional loan, then there isn't 100% financing options for that type of loan. There just isn't. They'd want to see that you either have the money to repair the home or enough money down or a bridge loan or private money or fix and flip. Or there's other ways to get it financed, but nobody's going to do 100% financing, not without either other collateral or experience, or it has to be just a killer deal, like way less than what it's worth. But even then, they'll still want you to do the rehab on it and have some skin in the game so you don't just buy it 100%, it's in total disarray, and then they have to foreclose on the home. So mortgage companies aren't in the business of foreclosure. They don't want to foreclose. They want to get their payments. They want to reinvest that money. So foreclosures is not something they're trying to do. And all of mortgage underwriting is lowering the risk of foreclosure. That's what it's all designed to do. Mortgage insurance is designed to kick in to help with the risk of foreclosure. So most foreclosure homes are going to have some sort of distressed or rehab that's needed on them, but you'll see like HUD homes or that don't really need that much work. You can get 100% financing on those if they qualify. So it doesn't matter if it's a foreclosed or a manufactured home or the type of home. I mean, there's nuance with that, but it's not like because it's a foreclosed home you can't do 100% financing. The only reason you couldn't do 100% financing is it's in disrepair or not in a financeable state. But it wouldn't really change the 100% because it's a foreclosure without its condition. Hope that makes sense. Get rambling on stuff. How many times can we top up home loan? Ooh, I wonder what maybe that's a different. Sometimes you'll see stuff from other countries on here. How many times can we top up? I have no idea what a top up home loan is. Sounds like a written question or something, doesn't it? Top of the day to you. All right. Laughing at my own jokes. What is the minimum period for a pre-closure of a home loan? What is the minimum period for a pre-closure of a home loan? Do they mean foreclosure? Oh, pre-closure. So what that pre-closure is like before you close. So what's the minimum period? So by law, we're supposed to issue a closing disclosure 3 days before you close, not counting federal holidays or typically Sunday. So you have to wait 3 days after you issue final closing disclosures, that so the client knows what they're getting into, make sure it matches what they've been told. So there's process of disclosure throughout the mortgage process to just compare what you were quoted with what you're actually getting, the final numbers. They call it a CD, or closing disclosure. You have to get that 3 days before you close your home loan. So that's probably that may be what they're talking about here, is that required period. And it is counts the day that the disclosure is viewed or signed. So it doesn't have to be like during business hours. So let's say you get off work and you see the closing disclosure at 8 p.m. As long as it's acknowledged that day, it starts on that day. So let's say it's Monday during the calendar, all the way up to midnight, right before midnight. That's when it starts the clock. Then you'd have Tuesday, Wednesday, you could sign Thursday. So that would be the waiting period. Unless Monday's a holiday or there's a holiday in there, then it would change those dates. Typically Mondays are the holidays. Obviously, there's days that fall differently, but most holidays seem to be observed on a Monday. So then that day wouldn't count. Or if you issue it on a Friday, and say we have Veterans Day coming up, then it would count Friday, Saturday, but then would give you Tuesday, then Wednesday you could sign. So you got to know that going into it, when you can sign after that closing disclosure is issued. But typically it's 3 days, unless there's weekends or holidays. Let's see. Can you roll a car loan into a mortgage? Yes, that would be a refinance. It's not on a purchase. So a lot of times I'll have people say, well, can I just roll fees, roll car loans into a purchase? And no, because the purchase is based on what you're paying for the home. But if you then have equity in the home, you could do a line of credit. You could do a new first mortgage that just increases the balance to wipe out that car loan. And it can make a lot of sense if you do something with the savings, or if you're just so tight on your budget, you can't stand it, and you just got to get some of the debt consolidated. Maybe your income or job situations change. I mean, there's other reasons to refinance, to roll in other debt. But a lot of times I try to sit down with clients and say, okay, we've freed up $1,000 a month. Let's take some of it, put it towards the mortgage. Let's increase some 401 contributions. You've obviously been used to making that payment for a while. Let's enjoy it. Let's fall back and enjoy a lesser payment, but let's also start maybe paying more towards the other debts, retirement, emergency, or even towards the loan. So in 5 years down the road, you'll be more ahead than just dropping your mortgage payment $1,000 a month. So it's part of the education process. It's part of looking at this more holistic, not just as another mortgage loan, but as almost a financial planning aspect. Now, I'm not a financial planner, so I can't recommend certain stocks or bonds or that type of stuff. I can refer you to financial planners. And a lot of times we team up with whoever you're already using, or even get you in touch with somebody that can say, okay, now that we've freed up some money, let's get smart with this. Let's get ahead on this. Let's start taking that money we've been used to paying for a while, because we spread it out over 10 debts. Now we only have a mortgage and maybe one other debt. Let's take that savings and do something with it. You'll be so much further ahead of the ball game than just dropping back to your payment. Because what you'll see is people drop off the $1,000 and a new car loan will show up in a couple of years, or more visas will get used, and all of a sudden they're just right back to where they started without anything to show for it. So that's where I think the refinance market can do a better job of educating people. Now, doesn't mean they'll do what we advise, but at least we have that advice that we can help people with. Let's see what else we got. How are we doing on time here? Maybe we'll go. Oh man, this little headset's messing up my hair, guys. Man, I gotta get a haircut. I always let my hair go longer, like in the fall. I don't know why I do that, but like in summer, I just always buzz it. But my wife likes the longer hair, so. Is it possible to take out a mortgage without telling your spouse? Yes. That depends on your state. There's some states that are community states, non-disclosure, non-community states. So there is some legality there, that just because they're not on the mortgage doesn't mean they don't have access to the asset. I think I've seen this in divorce situations where, hey, I want to go buy another house, but I don't want my spouse to know, or my ex-wife, or soon to be ex-wife, ex-husband, whatever it is. But the answer is yes, but that doesn't necessarily mean that avoids that asset in some sort of divorce situation, or the spouse won't know about it or something like that. Now, if you're trying to get the spouse on the loan without them knowing, that's a whole nother problem. No, that'd be mortgage fraud. The person would have to acknowledge it through ID, you have to notarize documents. I mean, so you can't have a loan with the spouse on it that they don't know about. But is it possible to take out a mortgage without telling your spouse? Yes, but I don't think that's a good idea. It isn't. If you're thinking about that, that means there's probably something going on with the marriage, and it's probably better to wait till that whole situation's resolved through divorce, separation, whatever it might be, but it is something where technically yes, but I don't think I would do that. Doesn't really mean the asset's protected. So, yes. All right. If someone has an existing mortgage, will it affect their ability to get a new mortgage? Yes, in the sense of the debt, but no in the sense that just because you have one mortgage doesn't mean you can't get another mortgage. Now, VA loans, certain loans, you can only have one out at a time. There's some exceptions to that, but generally there's certain types of loans you can't have more than two. But in general, you can have multiple mortgages, just each one has to qualify as if it was a debt. So if you have a $2,000 a month mortgage payment, you try to go get another $2,000, now you got to qualify for both. Now, if the other one's turning into a rental, sometimes that rental income can offset it. There's all kinds of guidelines on how that works. But in general, this is a broad question. So kind of the broad answer is yes, you can get multiple mortgage loans. Let's see. Can I get home loan insurance after a loan disbursement? Yes. You have to get the insurance before the loan closes in many cases, but you can change it. You do have to have proof of the insurance before we close, whether it's a refinance. It just usually carries over the other insurance and just make sure that the lender is updated. They call it the mortgage clause with the insurance company. So it just updates in case something happens. They get notified. If you don't pay your premium or it's not part of the escrow account or it gets missed or something like that, they get notified. So but you can switch that insurance. You don't have to use that insurance you started with, but you at least need to get the policy. We need to have evidence of that insurance before we're closing a purchase or a refinance. What are the most important things to consider when taking a home loan? Well, making sure you qualify. That's the most important thing, getting pre-approved and see what you qualify for. Make sure you're comfortable with that payment. I've seen times where, because we go off gross income and we look at income maybe a little bit different, you can qualify for more than what you're really actually comfortable with. You know what your other expenses are, child care or food allotments or just lifestyle or cell phone, other expenditures. You know what you have outside of just what's on the credit report or what you actually make. So it's important to be comfortable with that payment. And if rates get better, you can always refinance, but you want to be comfortable with that payment up front. You also want to consider when buying a home, there may be other expenditures with repairs on the home that you didn't have to do as a rental. And I know a lot of people don't buy a home because they're worried about that. When there is home warranties that you can get to kind of cover it, especially if the home is older or just want to make sure those things are covered. But it really is amazing how many people don't buy a home because they're worried about all these expenditures and all these things breaking. And I always tell them, I say, okay, you've been renting for 3 years, 5 years. How many times in that window did you have to have the landlord pay for something major? Like when was something major broken? I mean, obviously there's going to be times where people say, oh yeah, the air conditioner went out, a whole bunch of stuff during that window. But most people, when I talked to them about that, they said, yeah, there was nothing that broke during the time I was there. Maybe the garbage disposal or something kind of tiny, but nothing major. I mean, the stuff's built pretty long, built to last on some of this stuff, especially the heavy operation of the home. That's where a home inspection up front, I highly recommend it. Get those things tested. If things are at the end of their life, like a water heater, and it's a home that's 15 or 20 years old or something like that, you do want to check those things before you get into buying the house. But then through the home warranty, if you're really worried about some of those things, can really save you a ton of money, or just give you that peace of mind that if something does break. But I talked to so many people, and it's like, well, I've been renting the same house for 5 years and nothing broke, nothing major. Maybe a little odds and ends and wear and tear stuff, but nothing. It was like, okay, for 5 years you didn't have anything break, and that's why you're worried about buying a house. Well, do your homework before you buy the house. Get the home warranty if it's really an issue, and you'll probably have the same, and you'll get all the appreciation, all the tax benefits, all the equity, all the things you gain with that is going to offset really anything that major breaks on the house. So I think it's this kind of a narrow view and just an excuse not to buy a house when it's so much better to be a homeowner. There's so many things: financial, pride, location, settling down, customization. There's just so many reasons to own a home. How are we doing on time? I think we'll go maybe a little bit longer here. I'm having fun. Why not? What else are you going to do on a Thursday night? Football? Football. Should I take out a loan to buy a home? Yes. I'm drinking the Kool-Aid. But you can leverage a home better than you can leverage anything else. I see so many people that move into our area that bring these big down payments, or they bring enough to just pay cash for the house, and you can't get that money back without selling or refinancing. Or if you can get a loan that can debt service itself, get the tax benefits, there's a lot of reasons to get that loan. Go buy 3 houses. Why pay cash for 1 house? We wouldn't do that with stock or bonds. So I'm going to have 500,000 put in one stock. Nobody tells you to do that. Diversify. Why do we do that with real estate? And it's like, okay, they're going to get all the 500,000. I'm just going to use 500,000. They can get all the $500,000 now, or spread that out over the next 10 years. And while you're waiting for that money to go to the lender, you're earning a rate of return on that. You're earning liquidity. You're able to do other investments. You're able to pay off any other debts. There's just so many reasons to diversify that. When the mortgage loan is one of the best interest rates, locked in payment, 30-year fixed rates, regardless of really what the rate is, because that money stays liquid. Where if you put it all down, how do you get it back? You have to sell or refinance. What if you can't refinance because your job's changed, you're retired, spouse has passed away, debt situations change, you can't get to it. Now you have all this equity you can't even get to if you need it, versus having that money in mutual funds or stocks or bonds or retirement accounts or paying off everything else. Just, you want to look at all of it. And I've been able to talk to so many people. It's like, okay, you can become your own mortgage company by just not giving them all the money now, just spread it out over the next 10 or 15 years or whatever it might be. I have so many ways I can show you that just makes a ton of sense to not pay cash or put these huge down payments on a house. So if you're going to buy a house, get the loan. If you can qualify, get the loan. What else we got? How we doing? Almost an hour, about 10 minutes left. So let's see how many we can. Should we just do a rapid fire? Like, no, yes, no. Can I get approved for a home loan if I get a new job? Depends, but normally, yes. It depends on the new job. So if you go from self-employment W-2, there's some things there. If you go from, say, a W-2 job to self-employed, that becomes harder. If you go from a job that's, say, a wage hourly to commission bonus, we need a longer history. So, but it wouldn't prevent you. If you're just going from a W-2 40-hour a week to another W-2 40-hour a week, that's the easiest transition. You don't have to wait. I see a lot of people think, oh, now I can't get a home for 2 years. I have to have a 2-year history at that job. So there is reasons behind that, kind of thinking of that. A lot of it will come down to how we average the income. But I've actually had times where people are switching jobs, getting an offer letter. They haven't even started that new job yet, and we're actually able to do a loan based on offer letters or those types of things. As long as it's a wage or salary or something like that. As soon as you get into bonus, overtime, commission, self-employed, those require the longer history. But wage earner, there's usually ways to count that income. How can I get a house in the US without interest? You can't. Why would somebody, here's 300,000, just pay me back without interest? Just not how money works. It's not how loans work. So how can you have a home in the US without interest? Pay cash for it. But again, interest isn't a bad thing depending on where that money else could go and how you can maximize it. And really the interest rate on a mortgage is going to be the best interest rate you're going to pay. It's better than credit cards, car loans. I mean, it's so much better than other loans that are out there. Yeah, maybe 0% interest for whatever, but then after that, it's a big interest rate. So generally, you're going to have a longer fixed rate loan, cheaper interest on a mortgage than anything else. But it's just not how it works. They're not going to give you $300,000, $400,000, $500,000 and just get the money back. They're going to lose to inflation. They're going to lose the $500,000 is not going to be worth $500,000 in 10 years from now. So part of interest rate is offsetting that as well. That's why you saw rates go up when inflation went up, because the dollar was losing value, and so I had to make up for money that was being loaned out today. So that answer to that's no. Or you could get the seller of the house. Even then, why? No. The answer is no. The answer is no. I'm not going to try to find a way to make it yes. What's considered a good mortgage rate in the U.S.? The best that you can qualify for. So it could be 7%, it could be 12%. It depends. The rates are based on risk of foreclosure, down payment, credit scores, all that type of stuff. So the great rate is the best that you can qualify for. All right, let's see. Probably going to go over time, but hey, we're having fun. Should I pay off my mortgage even if I'm not retired? Generally, no. I'm going to say, okay, and this is kind of, we've talked about it a little bit here. I see too many people try to pay off the loan. In fact, I saw this guy that had worked crazy hard for like the last 5 years of his life, worked himself to the bone to just get his mortgage payment. He wanted to retire without a mortgage payment. And it was sad to see. It was like 3 years later, he had some health issues, had to get another loan, ended up passing away. It was just kind of it was like, man, that was a lot of work to get rid of that mortgage loan. Instead of saying, hey, I'm going to build up my savings, get rid of every other debt, get my nut to crack every single month as low as possible, so then it won't be as much of a burden when I go to retire. And I think that's a better use of that money than just accelerating the mortgage as much as you can. When it's like, okay, if you had 100 grand in the bank to make that mortgage payment, or 200,000 or 300,000 in the bank, also earning an interest rate to offset the interest rate you're paying, I think that's such a safer way to do it than just wiping out the mortgage. Also, if you were to do that and the mortgage is free and clear, and then you pass away or something like that, and your wife's in the house now, she hasn't had a job, she doesn't get as much income, her retirement's different, she has no cash in the bank, then they have to do reverse mortgages, which are more expensive. And I think this notion of getting rid of the mortgage payment before or close to retirement, I don't think is the best use of the money. But increase in savings, doing something with the money you were going to put towards the mortgage, towards retirement savings, I think that's a way better way to go. Because as you're paying down the mortgage, that's great. But what if you could be putting into an account that's earning a higher rate of return, that's kind of doubling up your money? It's giving you an opportunity to where that money is giving a little more money in return while your mortgage payment's locked in and fixed. That payment's going to stay the same the whole time, regardless of rates or inflation or all that kind of stuff. That payment's going to stay the same. So if your savings can be building up to make sure that payment is covered for 10 years, I think that's better than having that mortgage gone for 10 years. I just think having that money in the bank is just a way better, it's just safer, more confidence. Something happens to you, you've got that money to fall back on. You become your own bank when you have your own money, instead of always having to rely on getting to equity that you can't get to without selling or refinancing. So if you're getting close to retirement, if you have parents getting close to retirement, let's talk. Let's see kind of where we're at. And if you start seeing really stressing out on getting rid of the mortgage, let's increase the savings instead. Let's say, okay, instead of getting so tied up and doubling your mortgage payment, tripling that mortgage payment, let's take that money and put it into some ways that diversify that a little better than right towards the mortgage. We doing on time? Maybe 5 minutes left here. If you have any questions, please jump on the chat. We'll answer those. I don't do a ton of these stream lives, but just thought I'd have a little fun. I want to show off my nerd stuff. There's a whole bunch of stuff. Nerdmerch.com. I wonder if I could share my screen. I bet you I can. I bet you I can. Without having a problem. Our tech department has really a lot of safeguards and protections. That way we don't have somebody share our screen or steal information. So I don't know if it'll actually let me, which is a really good thing. Let's see if I hit share screen. I wonder which. Maybe window. Oh, hey, look at this. Hey, look at that. All right. Check out my website, nerdmerch.com. It's a little different than the mortgage thing. This is nerdmerch.com. And I've had just fun. I have fun coming up with these categories. Check out this. It's like nerd kind of in different ways. I thought this was fun, kind of upside down and backwards. Like I see it's like Dude Perfect and a couple of sports teams are all kind of making their logo upside down and background. I'm like, oh, it's cool looking. I don't know. It's just kind of cool looking. So there's that one. What else we got? Just regular old fashioned nerd. There's that nerd one. That one I thought was kind of fun. Just kind of, and then I got other categories. So down here is like the mug. I mean, how cool is the mug? Some stickers. And then here's like the science ones that kind of have more of a specific science kind of flair to it. And so I just kind of keep coming up with like cool little, kind of like the chemical thing. And then cars. I thought this one was kind of cool. Kind of looks like, it's just fun coming up with this stuff. Maybe my image there was blocking that one. So there you go. And then math. This got a whole chalkboard full of math equations. I thought that was just cool. This one might be a little, I don't know. This looks like a graft, And I just keep kind of coming. I jump in there and just come up with the new one. All the nerd cubed. I think that's fun. Check out this one. My brother gave me this idea. Kind of that nerd inside. That's kind of like Intel inside. That old logo that they used to have. I thought, that's kind of fun. And so I had some fun making that one nerd inside. I mean, it doesn't have to be just a computer thing. It can just be if you have a nerd. And then this one, what does that remind you of? I thought it was kind of like the Dell, kind of thing. This one's fun. Let's see if anybody knows this one. Let's see if I can click on. So this one, I had to kind of research it. But that right there is the binary, like the binary code 0100 for N. And I had the 3, that's for R and D. So it's actually the code for N3RD. So that's kind of insider thing. So if you're wearing the shirt and you're a nude, you're a nerd, and you have a computer nerd and kind of thing, and you can have that code. Well, what does that mean? You can kind of strike up a conversation and say, oh, I'm a computer programmer and I'm a designer or something. Where I just, that's kind of what I was trying to do with this. And then my little camera's blocking my screen here. Hold on. So we'll wrap this up real quick, but it's been kind of a fun little side project. I price these things out. I try to do the more premium stuff. I mean, it's not like it's a huge money thing. It's just more fun. I mean, I sell a ton to really do anything with it, but it's just kind of more for fun. All right, let's see a couple more categories: math, computers, books, comics. I kind of made that look like a superhero kind of thing. I thought that was kind of fun. Games, so there's like poker chips and poker cards and kind of game, that kind of way. I thought the hat with a chip on it's kind of cool. Gaming nerds, so I came out with this little gaming chair. I thought that was kind of fun. And then this right here is like the Settlers of Catan, how they had the little octagon little pieces. So I thought, oh, that's kind of cool, like a board game kind of thing. And check out the controller. The controller's cool. I'm laughing at my own stuff. But I mean, that's kind of cool because it's got, the old controller, but it's got N3rd as the buttons. And you can get on a shirt, you can get it on the hat. Oh, excuse me. Let's see, gamer chair. So I'm always kind of coming up with new ideas. If you have an idea, share it. DM me, check me out on my Facebook page, whatever. If you have kind of a category that'd be fun, I'm always looking for something. Sports was kind of cool, having on like the side leg of basketball, football. This one was fun too. I'm spending maybe too much time on this, but that's all right. This kind of is a little sports ticket. The idea, a parlay ticket. I just thought that was kind of cool. So that, it's just a fun way to do that. Let's see, let's back up here. My camera kind of blocks where I can hit the back button. Gym, just gym nerd mug, 45-pound plate, it just has nerd on it. I thought that was kind of fun. Bible nerd stuff. I thought the mug on the Bible nerd kind of turns out really cool. So I'm always coming up with new categories, new stuff. So thought that was fun. So nerd merch, nerd with the 3 N3rd. Check it out. Christmas coming up. If you have a fellow nerd and you want to get him a hat, then that gives you an option to be able to do that. So the more I wear this stuff, the more people ask me, oh, where'd you get that? And so I'm like, it's on this nerdmerch.com website. So I hope you enjoyed this. Please like, subscribe, please click on it. If you have any questions, I can put that in future videos. I've got podcasts I do. Boy, losing my voice. And just love to earn your business. The whole idea of all this is I really enjoy real estate. I love helping people with their financing. You can go to my website at ryanbolton.com. I'm licensed in Utah and Nevada, but I can help you in other states, either through Patriot, the company I work for, or refer you to somebody else out with my network. I've been doing this a long time, and I can help you with anything from private money lending, traditional lending, down payment assistance programs, all that type of stuff. So love to earn your business. If you'd like to look at any kind of financing, just have questions on credit, on any of that type of stuff, please reach out. Check out ryanbolton.com, and we'll see you on the next video. Thanks, guys.